Tesla will release results after the close on Wednesday, and to prepare, we're going to do our usual analysis of taking a look at management's guidance and comparing it to the consensus estimates heading into the release. So for that analysis, we'll be using our Tesla earnings model, which you can download on our website for free at gutenbergresearch.com. Click on the Models tab, scroll down to the Tesla model, and then just click this icon to download. So there's been a couple of new developments over the quarter. First of which is the details of the deliveries for the first quarter. And it sounds like, based on this press release that the company issued, this might be the last quarter that we actually get this information ahead of the quarterly releases. So that's important to remember for next quarter. But you could see that the guidance was at the low end of management's target, but it was pretty good that they split out the total deliveries for Model S and Model X, so that was helpful in our model. So we've updated our model to include these details. And then the other thing is the pre-orders for the Model 3 were very strong. So we do have Model 3 ramping in our model, but not in the current year. So we didn't change our earnings estimates based on the details of the pre-orders at this point. So we need a little bit more visibility before we do that. But we'll show you how that works in our model as well. So with that, let's bring up the shareholder letter from last quarter. We've highlighted some of the key guidance items. So if you go down to page 4, that's where the guidance starts. And we're just going to toggle back and forth because there's so many different things here between this and our earnings model. Okay, so before we get started, the Tesla model is very sensitive to changes. It's a tier 1 model, so we're modeling the full income statement, balance sheet, and cash flow statement. We think that this is critical for Tesla because they're in this rapid ramping stage. So monitoring the cash flow is extremely important as they continue to build out their production capacity. And that means that we value shares based on a price earnings based multiple and a DCF based valuation approach. And if you'd like additional details in our DCF, this DCF model is complex. There's a lot of inputs, and it's very sensitive to the assumptions that we make. So it's very important that you understand this. So check out on our website, we have a training page. If you go, again, back to gutenbergresearch.com, you can click on the education page, and it goes through 5 different videos that explain all the key aspects of all of our financial models. And you want to start with video 2, which goes through the details of how we actually calculate the inputs to the DCF valuation. We use Apple in this video, this demonstration video here, but Tesla's model works the same way. Of course, the underlying assumptions in the model are a bit different, but even still, it's a very helpful video, so definitely check that video out. And then in terms of building the income statement, there's a lot of non-GAAP adjustments, which we have a section below our segment details to explain that. I'm going to refreeze these panes just so we can get a better view here. That color legend is taking up important real estate, so we'll freeze it there. And you can see we model our income statement on a GAAP and non-GAAP basis. So we have the details below in our segment section for the non-GAAP items, and we'll go through that as well. But other than that, the principle is pretty much the same. We use some assumptions in the segment details to build our income statement up above. And down here is what we call our earnings engine. And by earnings engine, we simply mean the assumptions that drive our earnings in the results in the income statement up above. So you can see for Tesla, we have a section for the Model S deliveries and average revenue per unit and gross margin. Then we have a section for the Model X here, and then Model 3, which comes later in our model. And you can see I skipped over, but the zero emission vehicle credits are here as well. And up above, we have a summary of the total vehicle deliveries. And the reason we do this summary is because the company doesn't actually break out Model X from Model S and all the metrics, including average vehicle price or gross margin. So we have to make sure that we get back to the total automotive group gross margin and guidance, whatever guidance they provide for the average vehicle price. So this is kind of like a check section up here. But all of these, and then we also have the Tesla Power details down here. For now, it's all included in the other revenue category. So what we do is we just set up some units and revenue and gross margin for the power packs and the power wall. And then when the results come out, we just consolidate this information up into the other category. Below that, we have some segment details. So we have the OPEX items as a percentage of total revenue, and then assumptions for interest income, other income, effective tax rate. And then here, like I was saying before, this is the non-GAAP adjustments. So the primary non-GAAP adjustment is stock-based compensation, and then the revenue adjustment for lease accounting, which hits the total revenue and cost of revenue lines. And we'll go through the guidance that management provided on those items too. So with that, now that you kind of have a basic understanding of how we build our income statement for Tesla, let's take a look at the guidance that management gave us. So starting with the top line here. So this one is not actually a revenue item. They expect $1.5 billion in total capital expenditures. But the key to this is this last piece of the sentence, without accessing any outside capital other than existing sources that support our leasing and finished goods inventory. So that's for, this is a comment that's really implied to be for the full year 2016. And that's critical. We actually had to adjust our balance sheet quite a bit just to make sure that through the management of inventory and accounts payable, they did not have to raise additional funding, because that $1.5 billion of total capex is pretty significant. And it makes sense because they're going to start ramping the Model 3. But it's difficult to get the balance sheet to work in such a way that they don't actually require any outside debt or equity. And I'll just show you really quick. So this is actually not in the income statement. Obviously, it's in the cash flow statement. But if you scroll down past the balance sheet to the cash flow, you can see that we are modeling $1.5 billion of total capex for the full year of 2016. So in line with that guidance that management provided. Next, they talk about deliveries. So this is going to be a little bit outdated, but as of the first quarter of last year, as of the fourth quarter of last year, they estimated total 2016 deliveries between 80 and 90,000 units, which includes both Model S and Model X. And they expected 16,000 units in the first quarter of this year. So we know, based on the press release that they issued a couple of weeks ago here, that they actually came in at 14,820 vehicles. So we had to make some slight changes to this guidance here. Overall, though, in that press release, they did reconfirm that their expectation has not changed for the full year. So they're still expecting 80 to 90,000 vehicles for the full year of 2016. So for our first quarter of the year, we input the actual deliveries that were in that press release from a few weeks ago. So total Model S at 12,420 units, and then Model X at 2,400 units. And you can see that we are still modeling for the full year. We're in that range of 80 to 90,000 vehicles, but we're actually at the low end of that range. And we'll talk about why we're at that low end in a second. Okay, let's go back to the press release for the next piece of guidance. So we skipped over this one. Average vehicle transaction price to increase slightly during 2016. So obviously it's hard to say exactly what the definition of slightly is. And we know that Model X is more expensive than Model S. So as Model X becomes a larger percentage of the total units shipped, obviously the average selling price for the total automotive group results will increase. So for the full year of 2015, the implied average vehicle price was $95,000. And we are modeling just over 100,000. So we're saying that would be, the definition of increase slightly. Next, they say that they're expecting to lease about the same percentage of cars as they did in the fourth quarter. And that is important for the non-GAAP adjustments. So if we scroll down, because remember there's that lease accounting adjustment, and since we're saying that approximately the same percentage of cars would be leased, we didn't change our revenue adjustment due to lease accounting as a percentage of total revenue from the fourth quarter. So we left that constant, and we left our cost of revenue adjustment percentage constant as well, just based on that piece of guidance. Next, they start talking about the Model X a bit here and the manufacturing efficiency that they're expecting to achieve. So they say by year end, Model S gross margin should begin to approach 30%, and Model X gross margin should be about 25%, with continued improvement for Model X in 2017. This was actually a very important question that came up from one of the analysts on the call last quarter. So the analyst had asked where they expected to be about 18 months from now, and management kind of hesitated a little bit. They didn't really want to answer the question, but they finally did give an answer and said that they expected in that time frame they like to be at the 30% mark for both vehicles. So this is very important gross margin information. And the other thing to think about is they're saying they're going to approach 30% or be about at 25%. So even if they reach that point at the end of the quarter, the average for the full quarter is not going to quite be there. So we'll show you what we did to consider those items. So right now, the non-GAAP gross margin for Model S, it's hard to say exactly what it was because they didn't split the details out. And there were some Model X produced in that quarter, and we know that the margin for the Model X was probably pretty low just because they're not really producing that many vehicles. But based on the information that we have, we expect the gross margin for Model S to be just below 25% for the first quarter. And again, just like this, they pointed out here, they expect to be 30% by the end of 2016. But as we pointed out, they're not, even if they reach 30%, the full quarter of 2016 will not be 30% because, on average throughout the quarter, it should be lower than that. So we have it reaching 28% on average in the fourth quarter of 2016. And then at that point, after that, we have it reaching 30% consistently for Model S. And then if we scroll down to Model X, they're going to ramp quickly, and that gross margin should increase pretty quickly. And they said that it should be about 25% in 2016 with additional improvement in 2017. So if they reach 25% by the end of the quarter, we're saying that the average throughout the quarter would be about 24%. And then you can see for 2017, we have a steady increase from 25% to about that 30% mark that they had commented that it should reach within about 18 months or so. So we're saying it would reach it somewhere between here and here, and then the average for the full quarter would be some point after that. Okay, so let's go back to the press release. And the last couple of items that they talk about are the operating expenses, which they expect to increase just slightly from the fourth quarter in the first quarter of 2016. And then they say that they expect the full year operating expenses to increase by about 20%. Now, in order to get back to the consensus EPS estimate for the next 4 quarters, we had some difficulty with the operating expenses. And now, before we can explain that, we just need to make sure you understand exactly what is left on the income statement. So we're all the way down here. So other than operating expenses, we have interest income, other income, provisions for income tax, and then some non-GAAP adjustments for net income. So, and you can see that for each one of these categories, we left them relatively unchanged from the last couple of quarters, the average for the last couple of quarters. So we're saying that those estimates are probably reasonable, and all in all, they don't really impact earnings all that much compared to operating expenses. So the only other thing that we can really adjust in order to get back to the consensus EPS estimates for the next 4 quarters is the OPEX items. So research and development and selling in general and administrative expenses. So we used our estimates for R&D as a percentage of total revenue to get back to the consensus EPS. And you can see that because this number is extremely exact. So obviously we use the goal seek function in Excel here to get back to that EPS estimate. And the only thing is when we did that, the total operating expenses actually fell a little bit short of what management's guidance was. So remember, in the press release, they said that for the for the first quarter, operating expenses should increase just slightly from Q4. So if we look, Q4 in total dollars was about 429 million, and now our OPEX implied by the consensus EPS is actually showing a sequential decline, and that's why we highlighted this in red. And then it's a similar situation for the full year because management guided total OPEX to increase year over year by about 20%. But in order to get back to the full year EPS consensus estimate, we actually had to increase OPEX by 29%. So this might be showing that overall for the full year, the consensus estimate is maybe a little bit conservative, but for the first quarter, the consensus may be a little bit aggressive on the OPEX side. And then just in regards to the OPEX assumptions and the fact that it kind of steers away from management's guidance, the whole point of our calibration to meet the consensus is to really provide a baseline scenario for our users. So you can go ahead and download this model and plug in your own OPEX assumptions. So it's pretty easy to just change the R&D and selling and general and administrative expense as a percentage of revenue. So these 8 cells, and you can change the full year 2016 OPEX to be in line with that 20% growth rate that management gave. And then right away, you'll see what the impact is on total EPS and valuation. And on that note, we can kind of talk a little bit about the valuation heading into this release. So we've recalibrated this model to meet the consensus, and in terms of the multiple valuation, shares are now trading at about 224 times the next 12-month consensus EPS estimate on an ex-debt per share basis. And that's not the high over the last 3 months, but it's definitely a little bit above the average. This is another thing that you could change here. And if this multiple looks abnormally high, it's really just because the valuation is really not based on what the earnings of the company are going to be over the next year. But since Tesla's a growth company, it's based on what the true earning capacity of the company is on a long-term basis. So, many years down the line when they reach a normalized earnings base. So you could make some adjustments to the multiple. You could push it out to value based on 2017 or 2018 EPS if you'd like, or you can apply a growth adjustment to it. Either way, you get back to a similar valuation, just different metrics for the market multiple. And then for our DCF based valuation, like I was saying before, there's a number of assumptions that go into this metric. So definitely check out our DCF valuation video, which explains all of these metrics. And these could be some things that you might want to play around with too. So if you think that volatility in the equity markets is going to increase, you could change this number. Or if you think interest rates are going to rise over the next year, you could change this and see what kind of impact that would have on Tesla shares. Just keep in mind that Tesla's value is very volatile, and this model is extremely sensitive. So if you change the net working capital assumptions, if you change the OPEX assumptions or the shipment growth rates, the earnings and the valuation will change very quickly. Be sure to check back after the release. We'll update the March quarter for the new results, and we'll update the 2016 full year guidance based on what management gives us. And if you're interested in financial modeling, please subscribe to our YouTube channel. Thanks for watching, and good luck with the rest of earnings season.